You're listening to the SAFM Market Update with Moneyware, brought to you by the Escalator Funds from Discovery Invest. Discovery is an authorized financial services provider. Well, David, you did see the figures to come out of Statistics South Africa yesterday, saying retail sales, we spoke about them briefly last night, down 4.5%. Next to you is Marc Wainer, who's one of the bigger landlords in the country. Mark, let's just qualify that. How many retail tenants do you have, or do you look after?
We've probably got retail tenants in excess of 2,500 to 3,000.
All right, so you know what's going on in the retail sector as a result of that.
Yeah, pretty much.
And what's their experience been?
Well, I think it depends on the sector. We're getting very, very mixed signals, depending, on the type of customer. So in major regional malls, very little difference. Foot traffic is marginally down, maybe 1% over the last quarter. But sales per head are static. In the commuter market, again, foot traffic stable, but sales per head increasing. I think that's largely on the back of increased food prices.
What's a commuter market?
That would be what we call secondary centres, where they're serviced by taxis, trains, rail, that sort of market. Much smaller shopping baskets, shopping every day. But I think that increase in sales per person or sales per visit is been driven largely by increases in food prices. And then, of course, the clothing sector has held up remarkably well. We're not seeing much fall off there. Furniture, really badly affected. Furniture, white goods, they really are going through tough times. Fridges, stoves, those kind of things. Big ticket items, the flat screen TVs, those kind of things, sales are down. Then other ones which took us a little bit by surprise, for example, toys. Toy sales down. And I think, obviously, toys are a luxury, and that is going to hurt. Obviously, if you've got exposure to the motor industry in any form or shape, that's taking big strain. Seeing lots of, and if you just drive around Johannesburg, you'll see lots of showrooms that are now empty, where they've moved and consolidated, still paying the rental, but not operating out of the premises. And I think we'll see a lot more of that. The health sector, the Dis-Chems of the world, doing incredibly well. I think people have got headaches from the kind of thing we're in. So it's very mixed. And even things like jewellery. We talk to some of our jewellers and we see pretty good sales. But then again, it's coming out of things like watches as opposed to diamonds. Now, why people are buying Rolexes or whatever, take a view. But those kind of sales seem to be up, whether people are taking advantage of maybe what they perceive as a relatively good price in terms of the dollar against the rand, and it's going to weaken, and they're buying those kind of things as a hedge. It's a different market, and that's the affluent people. So pretty spread across the board. But clearly the smaller centres, what we would term community centres, small centres where you've maybe got a food anchor and line shops, they're taking big strain.
Are you finding, though, that you are now seeing shops close, that people are because I've noticed in certain shopping centres,
smaller shopping centres which we don't really have big exposure to. I think March was the first month where we started seeing a few requests for rent rebates. The food guys, the restaurants are taking strain clearly, and there we're seeing a buy down. It's the upmarket restaurants, your Steers, your Wimpys seem to be benefiting from that. So I think people are just eating down, not going as much. Movie attendances, and that might be product related, are also down. So I think what we're seeing really is good support at the lower levels, if you like. Fashion holding its own, which surprises me. I can't understand it, but maybe winter will change that. And then we're starting to see a slowdown on what I would term the non-essentials, the toys. Liquor sales are holding their own.
How long do entrepreneurs, of say the person who runs a toy stop, how long do they hold on for in this kind of an environment?
Well, I think as long as they can, and I think that's where we, if we call ourselves a responsible landlord, we have to step in. So what we do is on a monthly basis in our centres we get turnover figures, and if we see the trading densities are such that the guy's not going to make it, we go and talk to him and say, listen, maybe we better find another tenant for this particular store, or can we help you in maybe re-engineering the business, cutting the size.
Can you do as much as, can you do that? Can you help people?
We can try. We try. I mean, for example, if you take the restaurant business now, where you've got a franchise supporting the business, they do things. They re-engineer the menu. So instead of having a 300-gram steak, you'll have a 200-gram steak, because you can't just keep pushing price increases onto the consumer. But the individual kind of just carries on going and hoping that tomorrow more people are going to sit at his tables, and it doesn't happen. If anything, it's just the converse. So we have that. But I think we're still going to take more strain. I think, I don't know if you saw today that a huge real estate company in the States filed for Chapter 11.
Big mall owner.
Big mall owner. And they, in the state, I mean, David will see it when he goes to Boston, if it gets time to go into a mall. It's devastation, because there you have tenants who are major tenants, major retailers who are going bankrupt, filing for bankruptcy, Circuit City, these kind, and you can't replace those kind of tenants.
In South Africa, though, you haven't.
South Africa, we haven't seen it. We talk to particularly to our major tenants. None of them seem to be really taking any kind. I mean, yeah, they would all like to do better. In fact, today I had a meeting with the CEO of one of the major retail furniture groups, and he told me they close off their month. They run from the 15th to the 16th, and for the first time in 12 months, their March figures were actually up on last year. But when he says up, he says maybe it's enough to take me out for lunch, but nevertheless they were up. And that's a sign.
We had a chat with Piet Viljoen earlier this week, and he said he didn't like South African property stocks because he felt their ratings had not reflected the reality of elsewhere in the world. You can get a better deal buying a property share somewhere else in the world. Now, you're invested offshore. Is that the case?
Yeah, look, I think you can get a better return, but one can't just look at return. The risks offshore are much, much higher. The reason you're getting those kind of returns is because people think a lot of those companies are going to go bust, like the one in the States. I mean, it was probably the second or third largest property company in the States that filed for Chapter 11.
A company that's big as in fact, bigger than Anglo American, to put it in context.
And they, one of the problems there, of course, is that their debt levels are much higher than ours. So our companies here, we've got a few things going for us. One is we've got built-in escalations. Secondly, and that to some extent protects against some vacancy. In the UK, for example, if you have a void or vacant shop, it's vacant. It's not like you're going to get 3 or 5% growth escalations from your remaining shops, which cover that hole. A hole is a hole. I think their retailers are under much more risk of default than ours are, the majors, because they don't have a lot of mom-and-pop stores. Everybody's got 20 or 30 shops, so you lose one. If you've got 6 malls, you lose it in all malls. And, their gearing is at 60, 70%, 80% levels, where ours in the listed sector averages under 30. So, yes, I think that our yields are conservative. And
but there's a good reason for it.
And I think it's quite interesting that we're seeing a lot of investor interest offshore coming back.
Marc Wainer is Executive Director of Madison.